Welcome to Stocks in Translation, broadcasting from the New York Stock Exchange. I'm your host, Alexandra Canal, in for Jared Blickery. And with me today is my partner in crime, Sydney Freed. Kindly like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. And today we're welcoming in Adam Johnson, Bullseye American Ingenuity Fund Portfolio Manager. And Adam, let's start on the topic du jour, trade policy. We have a lot of back and forth headlines. There seems to be this de-escalation, particularly with China. We'll see. So I first want to get your broad take on that and some of the volatility that we've seen over the past month.
Well, curious choice of words, trade policy. There are probably a lot of people who are not sure there is a policy because the policy keeps flip-flopping. But I do think that what we're finding is that we're stumbling towards some sort of resolution. And we don't know exactly what it'll look like. But each day you get a little bit of progress. There's a sort of Paula Abdul aspect to it, 2 steps forward, 1 step back. But we are making progress. And I think the ultimate goal is to level the playing field. I'm not sure that's really been conveyed as effectively as it could have been, but just consider this. Over the past 10 years, the U.S. has charged a tariff of about 2.7% on imports coming into our country. But when we send our stuff overseas, our exports, they on average face a 6.7% tariff. So 2.7 here, 6.7 abroad. So non-U.S. countries are charging U.S. exporters 2.5 times what we're charging them. And so I think ultimately the goal is to level that. Maybe it's to get everything down to zero, probably not. But at least if we were all tariffed at the same level, I think the market would breathe a sigh of relief. And I think businesses certainly would breathe a sigh of relief because they would know what the deal is.
Now, with these new duties, that's effectively raising our tariff rate to around 27% compared to the 6% that you were just saying on our exports. So what is a fair tariff rate in your view? Because clearly 27%, that's not sustainable, right?
No, and I don't think anybody thinks that's sustainable. I would imagine even the White House recognizes that's not sustainable, but it's a bargaining chip, right? We have the art of the deal in real time. I mean, arguably, we are all cast members of the latest season of The Apprentice, except that this particular season lasts 4 years. And so we're now in the chapter of the art of the deal. And, you know, if you want to settle at 10, you start at 20. And, you know, you work your way down. And so I don't think 27% is meant to be an end game. I don't think anybody thinks so. And Treasury Secretary Scott Bessent has effectively said as much, that we're negotiating. And the number changes from week to week. I don't know, are we negotiating with 10, with 20, with 30? No, we're back down to 18. But countries are coming to the table and they are presenting deals, for lack of a better word, and I think we'll get there eventually. And on the up days, the market is effectively telling you that.
Yeah, so I was going to say, what do you think of all this volatility? We're up, we're down due to all of this stuff. Yeah, but so what do you do in this situation?
Markets are anxious. They're jumping at every little bit that they get.
I know. Well, as someone who, first of all, is an optimist, but second of all, just made the statement that I think we will ultimately get a resolution and it won't be nearly as bad as we think. I'm buying. And it's hard to do. Buying in the hole is very hard to do. But it has served me well. And I actually put together a chart for my clients going back to 1980. And it's just amazing. 1987, and then the recessions, there are a couple of them in the 90s, 2000, the dot-com crash, 2008, the great financial, on and on. All these crises that in the moment are very upsetting, and they're little blips. And the stock market goes up and to the right. And I think you have to take that view over the long haul. If you need money for, let's say, a tuition next year, well, then you probably shouldn't be in the market. But if you're talking about building wealth over time and certainly planning for retirement, and you don't need money for 10, 20, 30, 40 years, you just put it in. As you get closer to retirement, you take that money out of stocks and you start putting it into bonds and other safer places. But you always want to have money in the stock market because that's how you grow.
Well, let's talk about bonds, because there have been a lot of headlines recently, this Sell America trade, whether or not bonds, the US dollar, if that's still the place for stability. Is that?
Yes.
Okay.
Yeah, in a word, I don't mix my words. No, yeah, the notion that somehow America has lost its exceptional place, right? That's a phrase we keep hearing, American exceptionalism and all is lost. I think that's people who don't agree with the current policy saying all is lost, but no, not all is lost. America is still the largest economy. It's the most profitable economy. It's where everyone wants to be. That's in theory why all these countries are coming to us and trying to negotiate trade terms with us. So I run the American Ingenuity Fund. All I do is invest in America because I think this is the best place to invest. I like our innovation. I like our ability to grow. I like the fact that we have generally free markets. We have a reliable accounting system, a reliable legal system. There is recourse. There is stability, generally speaking. So for all those reasons, this is where I deploy capital both for myself and for my clients.
And what are you buying? You said you're a buyer of, if you want to call it a dip. I know we're up a little bit. We're up and down. What are you buying?
We're up one day, down the next.
Exactly.
So I view my portfolio in sort of thematic terms. And right now, my largest allocation is to what I call compute. In other words, computers, computing power, mostly tech, though not exclusively, but the ability to compute more effectively. AI is obviously part of that. Data centers are a part of that. Sterling Infrastructure is a company that builds data centers. GE Vernova is a company that powers data centers. Just to go down a rabbit hole, because it's such a cool story. GE is a spinoff from GE Vernova's spinoff from the old GE. And what they did is they take the technology of a jet engine, but instead of mounting it on a wing and running jet fuel through it, they mount it on steel brackets and run natural gas through it. It spins, right? Creating thrust that in turn spins a turbine that generates electricity. So you can power data centers on site with natural gas. And the nat gas can be piped in, or in some cases down south, they actually have nat gas under the property. They just drill, and they're literally powering themselves with their own nat gas to create electricity. I mean, that's cool stuff. And that gets at compute, right? Because we're powering data centers. So compute is a very broad theme. Yes, it's Nvidia. Yes, it's Supermicro, and Celestica, which both assemble AI platforms so that you're in the AI business, and every company now has to be an AI company. There's so many different ways to play all of this, but semiconductors like NXP, Marvell Technologies, which is a semiconductor that focuses specifically on storage, right? I mean, you think about just compute, and there are a lot of different aspects to compute. So that's why it's the largest allocation in my portfolio. About a quarter, 25% of the portfolio is in compute. About another 25% is in the kind of Mag 7 plus. And I say take all the Mag 7 stocks, right? Apple, Amazon, household names, Google, et cetera. Add to that Salesforce.com, #1 for customer relationship management. Add to that Palo Alto Networks, #1 for cybersecurity. I love best in breed. And that rounds out sort of core ingenuity. So yeah, between compute and core ingenuity, that's half the portfolio. And there are about 40 names all told in the portfolio.
How does your calculus behind investing change when we're in a volatile time period like we are versus, when everything's stable? Like, are these all names you loved before and you're still saying buy, or like, how does that shift, especially for people who may be new to investing?
Sure. Yeah, I've wrestled with this myself because I was up a lot and then the market cracked. Not only cracked, it crashed. I mean, the NASDAQ from the high in January to the low, well, we hope it was the low, in mid-April, that decline was 28%. 28%. Oof. Small caps were down 32%. That's a lot. And, I transact in these names, so I won't give you the gory details, but I was up a lot and I was down a lot. And I'm on the way back.
That's what makes a market, though, right?
Yeah, and so in sort of the post-op, you come out of the operating room. How do we do, doctor? And you sort of say, well, is there anything we could have done differently or better? And admittedly, the only thing I could have done, and I don't really do this, is to hold cash. I still like all of my names just as much. The fact that we had volatility associated with trade tariffs and with sort of a tiff, if you will, between the White House and the Fed, will Jerome Powell keep his job or lose his job?
Sounds like yes at this point.
Yep. And no one wants to see mom and dad fight, right? So fortunately, I think Messrs. Trump and Powell
that leads to some of that instability that we were talking about.
And none of the names, none of the stocks, the companies that I'm buying are are directly really impacted. Okay, fine. Nvidia, yeah, they sell to China. 12% of their sales are to China. Okay, fine. But for the most part, American ingenuity is not going to be directly impacted. My 40 names in the portfolio aren't directly impacted, for the most part, by Fed policy or by trade talks. Yes, interest rates affect the market as a whole, and trade disruption affects the market as a whole, but not my names, right? So
They have the cash.
yeah,
You don't need to borrow capital.
and I'm not being paid to hold cash. I'm being paid to make money for people. And the beauty of what I do is that I'm a portfolio manager. I'm not a wealth manager. So I'm not trying to allocate between stocks and bonds, gold, cash, real estate. No, that's not my job. My job is pick stocks that go up. And I always tell people, I don't want all of your money. I just want the amount of money you're willing to allocate to growth stocks. And that should be a slice of your portfolio. If you're young, probably 75 or 80% of your portfolio. If you're middle-aged, probably 30 to 40, maybe 50. If you're getting close to retirement, you probably back it down to 20 because they are volatile, and you want that other 80% to be in something stable like bonds or cash, because you're going to need it in your retirement.
Well, let's talk about the volatility that we've seen with some of those growth names, because you mentioned the Mag 7. They were the leaders of this bull market, and they've also been the biggest laggards so far this year.
And they'll be the leaders again.
Right. So how do you really assess that and make sure that you're still allocated an appropriate amount, hedging your risk? Is it really just exposing yourself to bonds and cash, or do you double down?
So I don't hold any bonds. So I hold approximately 40 stocks in the portfolio. I am almost always fully invested, and I allocate anywhere from 2 to 4% of capital at cost to the various names. So Mag 7 names, a Google, an Amazon, a Meta, they'll get 4% of capital. But the little tiny names that maybe you've never heard of, they get 2%. And then the ones in the middle get 3%. And for me, that's the way I manage risk. Well, that's one of the ways I manage risk. I always set a downside alert. So if a stock goes down 30, 40%, I sort of say, this isn't working out, down 30 or 40% from where I bought it. Should I cut it? Or should maybe even add a little bit more? And fortunately, I don't have too many names that go down that much. 40% is a lot. Market volatility, granted, 30, 35. You get to 40. I did have a couple that went down 40 at the low, and I held them, and I'm glad I did.
Okay.
But what I also do is I set an upside target. As an old mentor said to me, you're only rational once, and it's before you buy the stock. So set a target, and when it gets there, sell a third or a half, just sell something, right? And then you can redeploy the capital into something else, which, keeps the portfolio vibrant. So back to the original question, would I have done anything differently? The only thing I could have done is to hold more cash because I want to take a macro view on markets, and I don't really do that. So no, the short answer is I would not hold cash. What I have done is call clients throughout the sort of volatility, and I have said, if you want to put more money to work, I think this is a good time, and I think we will look back 6 months from now and feel that this was an opportune time to buy stocks. And on some of those crazy up days, these names move 20, 25% in a day. It's shocking. It's shocking. We're an incredibly volatile market right now. I think it's driven by algos. It's not smart people saying, what do you want to do today? No, it's algos trading headlines. And they will, as they say on Wall Street, they will rip your face off.
Rip your ears off. That's a great place to end, because we want to pick up on that point when we get back, but we have to take a quick break. Keep it right here. We'll be right back with more Stocks in Translation. All right, Adam, we were just talking about a lot of the volatility going on in the market, when to buy, when to sell. How do you know that it's time to let go, to just say goodbye to a stock? I know we hate to do it, but sometimes we get to that point.
Well, when a stock hits my target, I always sell a portion, typically about a third, and then I'll reevaluate the company. I'll run my cash flow analysis, look at the multiple, try to put a forward multiple on that future cash flow. And if the target that I arrive at is higher than where it's trading, I raise my target on the balance that I still own. And if I can't really come up with a target that's appreciably higher, I will sell the whole position. So I manage the portfolio one stock at a time. Not everybody does that, but it's what works for me. I don't try to make a call about the market. In other words, if my target were, say, 6,000 for the S&P 500 and the S&P got to 6,000, I wouldn't suddenly say, oh, well, sell 20% of the portfolio, right? Because I'm buying individual companies. I'm not buying the market. I'm buying individual companies. And that's why I think you have to have a target on each company and manage it that way.
How do you calculate the math for that? What goes into your target? Is that too complicated?
No. I mean, it's pretty straightforward. So let's take Nvidia, a stock everybody knows. I think they'll do $5 in earnings this year. And if we want to put a multiple on that, they're growing at 75%. So arguably a 40 multiple is quite reasonable, right? The S&P trades at a 20 multiple.
It's expensive.
At 20 multiple, and you're getting 12% growth. So I think Nvidia with 75% deserves double the multiple. Call it 40 and when I say multiple, that's a PE multiple or price to earnings multiple. Well, so if they're going to do $5 in earnings this year and I put a 40 multiple on it, that's 5 times 40, which is $200. There's your target. Stock's trading in the low 100s, so in theory, it's a double from here. Now, you may disagree with me on the multiple, say, oh my God, 40? How could you possibly put 40? That's way too high. Okay, should it be 30? Well, 30 gets you to 150.
Right.
I mean, right now it's trading at it's trading at a 20 multiple, right? It's trading at $100 with $5 in earnings.
100 was sort of that next psychological level for investors if we fell below.
Well, it got as high as what, 147? So you say, wait a minute. So Nvidia right now is trading at 20 times earnings, and it's got 75% growth. The S&P is trading at 20 times earnings, and it only has 13% growth. Why should Nvidia be trading at the same multiple as the S&P 500? It's too cheap. Buy Nvidia. That's the analysis. And based on the fact that, I think 40 is reasonable. My target, 40 times 5, the earnings this year, is 200. And if I think, by the way, that the earnings are going to be $6 for 2026, and I apply that same 40 multiple, well, now I get to 240. Right? So I know you're probably saying, oh, well, if you go out to 2052, they'll earn $20. So you'll say, well, you just keep raising your target. Yeah, that's right. That's the way growth investing works. You keep raising your target if you can justify raising your target, and you can if the company is growing its earnings.
You've mentioned a bunch of stock picks. You say buy Nvidia. What are other ways to play the AI trade right now?
Well, we talk about valuation. There are so many AI stocks trading right now in the teens. Celestica, ticker CLS, is one. Supermicro Computer, SMCI, is another. I mean, these stocks are trading at 14 and 15 multiple. 14. The S&P, again, the S&P is at 20. These are trading at 14 and 15. They're AI names and they're growing 30, 40, 50%. That's crazy. But they got absolutely crushed on the tariff trade because they have sales to China. And the assumption, the market said, oh, well, they won't be able to sell anything to China. No, that's not right. But the market, pendulums always swing too far. And so the market effectively said, nope, they're going to lose all their sales to China. We got to lop it off. And that's why they've gotten so cheap. And that's why guys like me run the numbers and say this is an opportunity. And so I buy on behalf of my clients.
And we're right in the thick of earnings seasons. We'll be getting a lot of those numbers. You say, though, that one concern you have is that guidance has been all over the place due to trade, due to tariffs. How are you factoring that when you calculate your risk versus reward?
And actually, it's not that guidance has been all over the place. It's that it's been nowhere.
Right. and we've seen different strategies, right? There's been some companies that have said, look, we're going to issue 2 different types of guidance. Another company says, we have a soft projection here.
Yeah.
So it's really hard to follow.
Yeah, I mean, think about it. If we were all CEOs, let's say we're all CEOs, and
I love that.
Thank you.
Yeah, and let's do our monthly CEO get together, and we'll go have drinks and talk about the business and help each other figure out how to navigate this stuff. I'm pretty sure the consensus among us would be, I've suspended my guidance because why would I go out on a limb? Why would I tell investors what I think our earnings are going to be when I don't really know what our CapEx, our capital expenditures, is going to be? Because I don't even know what our sales are going to be and I don't even know what our raw materials costs are going to be because the tariffs just throw everything into question. So The first thing you do as a CEO is say, we're suspending guidance. And we'll think that we will be able to manage through this. And we have a task force that we've created here within the company to manage the process. We have our own tariff war room. And we think we'll be able to navigate these treacherous waters. But we don't know exactly when the ship will pull into port. So we have suspended our guidance. And we will keep you apprised. We're all in this together, right? That would be the responsible thing for a CEO or CFO to do, and they're doing it. And so that, for me as an investor, is a little hard because I'd like to be able to run my own cash flow models, and
right.
yeah. But I also think that we've gotten way too accustomed to hand-holding. I mean, think of every time the Fed has a meeting, and then
they used to not talk to us.
They give us way too much guidance. Companies give us way too much guidance. Imagine if you, as a parent, ran your household the way the CEOs run their companies. They'd say, "Well, sweetheart, the past 12 weeks have been very challenging. I'd like to talk to you about why you had some C's." And what can we do to improve them for the next 12 weeks or quarter, right? And how do you think that next quarter will compare to the quarter a year ago, back when you were in third grade? Because now you're in fourth grade and you're smarter. So let's set some key improvement metrics. I mean, really, yeah, it'd be a disaster. So you can't run your family like a business, and I don't think businesses should be running themselves with this hyper attention to guidance. I mean, every 12 weeks, that's how long a quarter lasts. You got to come out and talk about how you've reinvented this or reinvented that. It's way too much. In the same way that the Fed comes out with their projections every 6-7 weeks and says, well, here's what we think GDP is doing, here's inflation on it. It's too much hand-holding. You know, there used to be a time when you ran the 40-yard dash, and if you won, you got a blue ribbon. And then somewhere along the way, everyone who ran the dash got a blue ribbon just because they finished. Right. And I sort of feel like that kind of hand-holding is not serving us well.
Okay, and real quickly, we only have about 30 seconds, but that's a perfect segue into a segment I like to call Lost in Translation.
Yeah.
What are the markets misunderstanding or getting wrong right now?
The markets are way too negative, and they need to just step back, relax, and realize that it's never as bad as we think. Whether it's the tariffs, whether it's political outcomes, whether it's the housing crisis, we got through that. I mean, on and on and on. We get through this stuff, and we just need to remember that. We're Americans, we're resilient.
All right, love that. Adam Johnson, thanks so much for joining the show.
Oh, thanks for having me.
We're winding things down here at Stocks in Translation. Please make sure to scan the QR code below for more Stocks in Translation, and to follow Yahoo Finance Podcast for more videos and expert insights. We're also on all of your favorite podcast platforms. We'll see you next time on Stocks in Translation.